You know, you don't usually see a stock jump 4% on the same day that management basically says, we're going to lose money next quarter.
No, you don't.
It doesn't happen. You tell Wall Street you're about to burn cash and they punish you for it. But that is exactly what happened with Alaska Air Group.
It's a classic case of the market looking at two different realities at the same time. You had a print that was technically a massive beat.
Massive.
Followed by guidance that on the surface looked like a disaster. You had huge intraday volatility, and then somehow the stock claws its way back to close up.
It closed at what, $50.87, up over 4%.
Yeah, it was wild.
I was watching the tape, and the range was it swung between 47 and 52 bucks. That is not normal for a supposedly boring airline stock.
Right.
So today on Talk Tickers, we are unpacking that Alaska Air Group Q4 and full year 2025 earnings call. And the big question we have to answer is, why did the market forgive all that bad news?
And to answer that, you have to look past the headline number. This is a story about what we call an execution beat, colliding with a guidance edge.
Okay, let's start with that execution beat, because when I saw the earnings per share number, my eyes, they popped a little. They reported adjusted EPS of 43 cents. The consensus, what Wall Street expected, was only 12 cents.
Right. So they nearly quadrupled the expectation. It's a huge, huge beat.
But I have to play devil's advocate here for a second.
Please do.
Usually when a company beats on earnings that hard, but the revenue is just sort of, it means they just cut costs to the bone.
Sure.
Did they just fire everyone and stop buying coffee for the pilots? Or is the business actually growing?
It's a fair skepticism. But in this case, it really wasn't just cost cutting. Revenue was $3.63 billion.
Okay.
Now, that was technically a slight miss, about 10 million shy of consensus, but it was still up almost 3%, 2.8% year over year. So the top line is growing. But the real story of the beat was their margin management and, the cash flow. They generated $1.2 billion in operating cash flow for the whole year.
That's a lot of cash for an airline. And I noticed they did something with that cash that shareholders tend to love. They bought back stock.
Aggressively.
Right.
And this is a huge signal. They repurchased $570 million worth of stock in fiscal 25.
Wow.
That's 11.3 million shares just taken off the table. They even bought back 30 million in Q4 alone.
Okay, can we just pause there for a second? For listeners who maybe aren't a CFO, why does it matter so much if a company buys its own stock? Isn't that just financial engineering?
It is, but it sends a really powerful psychological message. When a company buys back that much stock, management is basically screaming, we know our business better than you do, and we think our stock is too cheap.
They're betting on themselves.
Exactly. They're putting a floor under the stock price because now there's a guaranteed buyer in the market, the company itself. It's the ultimate sign of confidence.
It's the CFO putting his money where his mouth is. Okay, so backward looking, Q4 was strong, made money, bought back stock. But then we get to the guidance hedge. This is the part that made the stock wobble at the open.
This is where it gets messy. Management guided for Q1 2026, the quarter we are in right now, to be a loss and not a small one.
What was the number?
They're projecting an adjusted loss per share between 50 cents and $1.50.
Wait, $1.50 loss?
Potentially, yes.
So if I'm holding the stock, shouldn't I be terrified? I mean, the street was expecting a loss of what, 64 cents? $1.50 is a deep, deep hole.
It is. And it dragged down the full year outlook, too. For all of 2026, they guided to a range of $3.50 to $6.50 per share.
So the midpoint is $5.
The midpoint is $5, and the street was sitting up at $5.54. So logically, you have a Q1 miss and a full year guide down. That is usually a recipe for a 10% sell-off.
But instead, we rallied 4%. So we have to figure out what the hidden asset is here. What did investors hear on that call that made them say, I don't care about the Q1 loss, I'm buying?
I think it comes down to three specific narratives that really came through on the call. The premium pivot, the merger integration speed, and the fact that underlying demand, specifically corporate demand, is way hotter than the spreadsheet suggests.
Okay, let's start with that premium pivot, because for a long time, at least in my mind, Alaska was the hiking boot of airlines.
I like that.
You flew them from Seattle to Anchorage, maybe down to LA. It wasn't exactly known for luxury, but the numbers seem to say that's changing.
The shift is undeniable. In Q4, premium revenue was up 7% year over year.
Okay.
That outperformed the main cabin, the cheap seats, by 9.5 points.
Yeah.
Premium revenue now accounts for 36% of their total revenue.
36%. That's That's starting to sound like a legacy carrier, like a Delta or a United.
Exactly. They are successfully selling the front of the plane. And the big question has always been, is this just, leisure travelers treating themselves, or is the corporate traveler finally back?
Right, the road warrior is
Yep.
back.
And that was the golden nugget from this call. Andrew Harrison, their chief commercial officer, he dropped a stat that probably saved the stock on the day. He said managed corporate bookings for Q1 2026 are up 20% year over year.
20%, that is a massive jump. Who is flying?
He got specific. He said it's driven by the technology and financial services sectors. And crucially, they're seeing fair market share on their new routes to Tokyo and Seoul.
Okay, now that paints a picture. This isn't just someone flying to a satellite office in Portland. This is high-yield international corporate travel, tech workers going to Asia.
And that connects directly to their credit card strategy. You know how airlines are basically becoming banks that also happen to fly planes?
Oh yeah, the loyalty programs are the real business.
Well, Alaska is finally cracking that code with the tech demographic. They launched this Atmos Rewards program and their new Summit credit card. In just 4 months, they got 75,000 signups.
Wow.
But here's the kicker. The premium cardholders, the ones paying the higher annual fee, they're spending 2 times more on the card than the base cardholders.
So they are capturing the high spenders.
And 60% of those new card accounts came from outside the Pacific Northwest. 25% came from California.
That's interesting. They're shedding that Seattle-only image. If you can win California, you win the war in the airline business.
Precisely. They're capturing those high-value flyers in the Bay Area who maybe used to be loyal to United.
Okay, let's shift gears. The second big theme, the merger. Alaska bought Hawaiian Airlines. That closed recently. And, airline mergers are usually a complete nightmare.
Oh, yeah.
You've got angry unions, lost bags, systems crashing. How is this one actually going?
Surprisingly fast. They achieved a single operating certificate, or SOC, in October of 2025. That was just 13 months after the merger was announced.
13 months? That sounds fast.
It is lightning speed in the airline industry. It means the FAA now views them as one single airline. They can mix crews, mix fleets, optimize the entire network.
But there's still one big hurdle left, right? I saw a note about April 2026 being a risk date. What happens in April?
April is the PSS cutover.
PSS? That sounds like a medical condition. What is it?
It stands for Passenger Service System.
Yeah.
Think of it as the central nervous system of an airline.
Okay.
Reservations, check-in, boarding passes, baggage tracking. Everything that happens from the moment you buy a ticket runs through the PSS.
Oh, boy. I feel like I've seen news footage of this going wrong. Lines out the door, people sleeping on the floor of the terminal.
It is the single biggest operational risk point in a merger. If that data migration fails, the airline just stops.
Right.
Literally. But management seems confident. They say they've done the back-end work. Once that flips in April, the friction is gone.
And that's what unlocks the real network synergies.
Exactly. They're launching Seattle to London and Seattle to Rome in spring 2026.
That is huge. Flying direct from Seattle to Rome on Alaska. That feels like a totally different airline than the one we knew 5 years ago.
It really is. It connects that whole West Coast network directly to high-demand European leisure destinations.
But we have to talk about the tech side of things a bit more critically. They did admit on the call that 2025 had some IT outages. And honestly, for a company trying to pitch itself as the premium choice for Silicon Valley, you can't have your systems go down.
No, you absolutely can't. And Ben Minicucci, the CEO, he owned it. He called it painful. They're bringing in third-party experts to overhaul their infrastructure resilience. It's a bit of a we're fixing the plane while flying it situation with their IT stack.
So the risk is that the April cutover just aggravates those existing IT fragility issues?
That is the fear. But they claim the capital expenditure, the money to fix it, is already budgeted. So we'll see.
Okay, let's circle back to the guidance friction. We talked about the corporate boom and the merger speed. So why the scary loss projection for Q1? Why did they guide for such a huge potential loss?
It's what we call a kitchen sink guide. They threw every potential negative into the forecast to lower the bar so they can step over it later. But the biggest culprit is fuel. Specifically, West Coast refining margins.
Is fuel really that volatile right now? I thought oil prices had kind of stabilized.
Global oil, yes. But the West Coast is basically an island when it comes to fuel refining. It's isolated from the rest of the U.S. pipeline network.
An island.
Economically speaking, yeah.
Yeah.
If a refinery goes down in Texas, they can pipe in gas from Louisiana. If a refinery goes down in California, there's no backup pipe. Prices just spike immediately. And Alaska is uniquely exposed to this.
Because so much of their flying is up and down the West Coast.
Completely. And Shane Tackett, the CFO, he gave a sensitivity metric that you really need to write down. He said a 10-cent change in the price of fuel swings their EPS by 75 cents.
Whoa, wait. Say that again. 10 cents on the gallon moves earnings per share by 75 cents.
Yes. It's massive sensitivity. So when they give a guidance range for the full year that's $3 wide, from $3.50 to $6.50, they're basically saying, we have no idea what gas prices in California will do.
So if fuel stays calm, they hit the high end. If a refinery breaks down, they hit the low end.
Exactly right. That explains the wide range. It's not that they don't know their business. It's that their biggest cost input is swinging wildly, and they can't hedge it perfectly.
But they did reiterate the big goal, right?
They did. They're still committed to $10 of EPS by 2027. They argue all the building blocks are still intact.
So if you're an investor, you're looking at a stock around $50. If they hit $10 in earnings in 2027, that's a PE of 5. That is dirt cheap.
That is the show me story. But before we get too excited, we missed one critical piece of macro context from the call.
Right. Is this just an Alaska story, or is the whole industry shifting?
It's an industry shift. We have to talk about GDP versus capacity. For the last couple of years, airlines added way too many seats. Supply was higher than demand. But on this call, management noted that industry capacity is finally aligning with GDP growth.
So the glut of empty seats is finally gone.
It's normalizing.
Right.
And it gives them pricing power. And then there's the economic fuel price. They mentioned $2.57 per gallon as their baseline.
Is $2.57 a good price for them?
It's manageable. It allows them to be profitable. As long as it doesn't spike to $3.50, the model works. And this macro stability is why the buybacks make so much sense. They see a stable environment with a temporary fuel scare, so they're buying the dip on their own stock.
Okay, that makes sense. So let's synthesize this. You're a portfolio manager. You see the print, you see the messy guidance, but you also see the strong execution. What's the signal here for the broader sector? Is Alaska an outlier?
I think Alaska is a specific signal for the tech recovery. Remember, their corporate exposure is heavily weighted to Seattle and San Francisco. If they are saying corporate bookings are up 20% driven by technology and financial services, that's a leading indicator.
A leading indicator that the tech recession, or at least the travel freeze, is officially thawing.
Exactly. If employees at Amazon, Microsoft, and Google are getting back on planes, that changes the economics for Alaska way more than it does for, say, American or Delta.
And the international piece is key.
So key. They mentioned filling business class seats to Tokyo and Seoul. That is long-haul, high-margin revenue.
It really feels like they are successfully pivoting from being a regional airline to a global boutique airline.
That's a great way to put it. Global boutique. They aren't trying to be everything to everyone. They're trying to be the preferred carrier for the West Coast affluent traveler. Mm-hmm. And we shouldn't forget the Starlink rollout.
Oh, right, the Wi-Fi.
They're putting Starlink on the fleet, fastest Wi-Fi in the sky. They said 50% of the fleet will have it by the end of 2026.
See, that actually matters. If I'm a tech worker and I can take a Zoom call at 35,000 feet without lagging, I'm booking that flight.
It's a tangible differentiator. You combine Starlink, the new lounges, the Summit card, the direct flights to London. It's a very cohesive strategy.
So the execution beat was the Q4 numbers and the buybacks. The guidance hedge was the scary Q1 fuel warning. But the market chose to focus on the execution and the demand signal.
Correct. The market is forward-looking. They see the 20% corporate booking growth as the real signal and the fuel volatility as just noise.
All right. That brings us to everyone's favorite part of the show. We have looked at the numbers, we have spun the globe, and now we're going to pitch something completely speculative.
This is not financial advice segment.
Please remember, listeners, we are just two voices in your headphones. This is for entertainment. Do your own diligence. Don't trade your kid's college fund on this. But looking at this data, I think I have a trade.
Let's hear it.
I call this the Silicon Valley straddle, or maybe the jet-lagged tech bro arbitrage.
Okay, I'm intrigued. What's the setup?
The setup is that one specific data point from the call. Corporate bookings up 20%, specifically in technology, and they're filling business class seats to Asia.
Okay, we established that.
So if software sales reps and venture capitalists are getting on planes to fly to Tokyo and London to close deals, what are they not doing?
They're not sitting in their pajamas taking Zoom calls.
Exactly. We spent 3 years hearing that business travel was dead because why fly when you can video conference? But this data suggests that for high-stakes deals, face-to-face is back. This is a return-to-office play disguised as an airline trade.
So how do you trade it?
You go long Alaska Air Group ticker, ALK, and you go short video conferencing stocks.
Oh, I like that. You're fading the work from home valuation and buying the face-to-face valuation.
Precisely. Alaska is the proxy for the West Coast tech economy getting back on the road. If they're seeing a surge in travel, it means the era of let's just do a video call is waning for high-value interactions. You capture the premium revenue upside of ALK, and you hedge by shorting the tools that keep people at home.
The logic holds up. I mean, if that 20% booking number is real, it represents a genuine shift in behavior. And Alaska is uniquely positioned to capture it because of their hubs. You don't close a billion-dollar merger over a choppy video feed. You fly there.
Plus, you get that buyback support on the ALK side. Management is effectively putting a floor under your long position.
But we have to play devil's advocate. What's the risk factor? What blows this trade up?
The risk is the IT outage. If Alaska has another system meltdown like in 2025, or if that April PSS cutover fails, the fleet gets grounded.
And in that scenario, the stock tanks and the tech bros are stuck at the airport, probably jumping on a Zoom call to complain about it.
Exactly. The whole trade implodes. High risk, high reward. That's why we call it the not financial advice segment.
It's a compelling thesis, though.
Yeah.
It bets on human nature. Eventually, you have to go shake someone's hand.
And have a nice glass of wine in the premium cabin on the way there. All right, let's recap. Alaska delivered a solid beat, 43 cents versus 12. They're proving the merger is working. And despite a very conservative kitchen sink guidance for Q1, the booking data shows a massive surge in premium and corporate demand.
The guidance was a hedge against fuel volatility, plain and simple. But the buybacks and the booking trends, they just screamed confidence. The market saw through the noise, and that's why the stock rallied.
It's going to be a volatile Q1, folks. Keep your eyes on those fuel prices in California and watch out for that April integration date. But for now, it seems like Alaska is climbing to a higher altitude.
Keep your seatbelts fastened.
Thanks for listening to Talk Tickers. We'll catch you on the next deep dive.